The Mark Twain Effect refers to the pattern of stock returns being lower in October compared to the rest of the year. The term comes from a line in Mark Twain's novel, October. This is one of the peculiarly dangerous months to speculate in stocks. The others are July, January, September, April, November, May, March, June, December, August, and February. While there is a ring of humor, it also highlights a serious aspect of investing, which is never speculate. Do not try to time the market. Missing just 30 best days can wipe out entire returns over 15 years. Out of 32 years, while markets always had an interim correction, only in 9 years did the market end the year with negative returns. In other words, for 23 out of 32 years, the markets ended in positive despite the temporary decline in between. 10 to 20% temporary drawdown is almost a given every year. Despite the Nifty moving up from its lows in June 22, the valuation indicator has not moved in line because earnings growth has improved. It is possible that the growth trend of GDP can be very different from the growth trend of stock market, because composition of GDP and stock market are very different to each other. For reference, 1. Financial services constitutes 31% in Nifty 500, but it only constitutes 6% in the GDP. 2. Real estate and professional services constitutes 15% in the GDP, but they're hardly any weight in the equity index. 3. Similar is the case with trade, hotel and restaurants. Even if the economy shows any sign of slowing down, it is not representative of the equity market. The levers for the next capex cycle are in the place, with industry aggregate capacity utilization rising from 68% a year ago to currently around 75%. Credit growth is at a multi-year high of 16% and expected to inch up steadily. A revitalized real estate sector is likely to provide benefits for the various allied sectors. Earnings growth for the second half of the financial year 23 is expected to be much better than the first half. As per the temperature gauge index, valuations are in fair valuation zone. For incremental investments, we continue to suggest 50% deployment immediately and 50% to be staggered over 3 to 6 months, while being able to accelerate deployment during sharp corrections. We continue to maintain bias towards multi-cap and select mid and small cap strategies across MF, or PMS, or AIF platforms. In the fixed income market, yields have increased across maturities and are higher than pre-COVID levels. Yield curve has become flat, with short-term yields rising more than long-term yields. Core part of the fixed income portfolio can be locked in at higher accruals without taking high interest rate risk or credit risk. Hence, for fixed income portfolios, we suggest core allocation to 4 to 5 year maturity segment through high credit quality, target maturity debt funds, which invest in a combination of GSEC, state development loans, SDL, and AAA rated instruments. Tactical allocation to select high yield strategies, MLDS, REITs, InvITs can help enhance the yield on fixed income portfolios. Different asset classes exhibit low correlation to each other in the long term. Delphi, ASAP, is an all-weather strategy that benefits from asset class diversification and yearly rebalancing. It is positioned as a superior alternative to fixed income,